Hello. Hi all. Can anyone hear me or can anyone see my screen? If do so, I greatly appreciate. Just give a shout out over at the chat box over there, so I could know that. So I can know that everything is good and we are ready to go in a couple of minutes time. Hi, I do see some of you guys already logged on. Greatly appreciate that if you could just help me tap a shout out over at the chat box over there that you can hear my voice and as well as see my presentation screen. Thank you. Great, thank you so much. So let's wait for a couple of more minutes, about 2 more minutes before we kickstart. Yeah. All right, good. So right now is 7 p.m. sharp Singapore time. So without further ado, let's kickstart this very exciting webinar. So in this particular webinar, in this 1 hour, I will share with you all the outlook. I would say it's a Q2 outlook on the FX market. All right. So before I start over here, some of you all may not have known me. I'm Kelvin Wong, the market analyst from CMC Markets. So basically, I've been in the industry for close to 15 years, specializing in technical analysis. All right. So before I start on the proper webinar, let's take a look at the disclaimer slides first. All right. Okay, so in a nutshell, whatever I share with you all in this webinar is purely for education purpose. All right, let's go. So basically, this is me, myself. So for those who have already known me, pardon me for a while, I just do a quick introduction for myself. So as I started earlier, I've been in this industry. We're talking about industry as in financial markets trading, as well as analyzing the financial markets, close to about 15 years. Yeah. So I started off as a junior economist, forecasting exchange rate, particularly in the ASEAN region. Then thereafter, I was given the opportunity to actually move to the buy side hedge funds. So this is where I start to pick up strategies, i.e. that means using a mix of tools, let's say technical analysis, combination with fundamentals to actually help in formulate trading strategies. All right. So I would say that this particular webinar is only part of CMC services. So if you'd like to find out more what we do offer, we can actually have a kind of a discussion towards the end of the webinar. All right. So those who actually wants to actually follow me on social media, I'm actually very active on social media, and I tweet every day on the market commentary, or I see something very interesting on the markets as in financial markets. So I do cover pretty much in depth on the forex market, the stock market, and as well as US equity and Hong Kong equity, and some Singapore stocks as well. So those who wants to follow me on social media, you can actually follow me on Twitter. So how do you find me? Later I'll share with you on my Twitter account. You can actually type in at Kelvin SC Wong, then just click follow. All right, there you'll be all ready to set up. Okay, so now, okay, so before we jump into the technical analysis chart of the various pair that I want to highlight to you all, let's have a kind of a quick summary, the overview on 2021 year-to-date FX performance. That means I'm talking about the majors, including the Aussie, the New Zealand dollar, as well as the CNH will be the China yuan, as of 5th of May, okay, which is when I start preparing these slides, okay, or webinar. Okay, so why do I include in CNH? Because as you all know that China itself right now is a very significant player in the FX market, and movement on the China pair or the China Forex, China exchange rate, pardon me, will actually have a significant impact on various cross asset class like equities. Okay, so those who could remember that previously somewhere around in 2016, where China actually devalue their CNH, their renminbi, it actually caused a negative ripple effect across the global equity. So without further ado, let's take a look at the performance. So how do we rate this performance up? What I do over here is that take it in the sense that if you see the line that is sloping upwards, that means we're talking about that particular pair is actually appreciating against the dollar. Okay, so what I did over here, I plotted as 1 Canada dollar equals to how many USD. All right, so everybody clear? Yes or no? So just give a little shout out over at the chat there so you all could understand the mechanics behind it. Clear so far? Great. Okay, so what you could see over here, right? This is the start of the year. So previously, at the early part of the year, almost all the currency pair is actually appreciating against the dollar, except for the Swiss and the yen that are actually kind of kind of what I call it uh depreciating, okay, against the dollar. So what we could see over here is that then thereafter, right, somewhere around we're talking about the start of the start yeah, I'll say around somewhere around early March. Okay, early March, the dollar actually started to appreciate against all the majors. Okay, it came coming down, coming down until towards April onwards. So towards April onwards, you realize that hey, the rest of the major pair has starts to appreciate against the dollar. So the strongest that we see so far is the Canada dollar, up 3.5%, then followed by the sterling, up 1.58. Then you come have our Asia side will be the renminbi CNH, up 0.23%. Then thereafter you have the Aussie, the Kiwi, and the one that is kind of lagging behind is the Swiss franc and the Japanese yen. Okay, that are still in negative territory. That means we're talking about as of 5th of May, the Swiss franc is actually kind of underperforming the dollar by negative 3.39%, and the yen is underperforming the dollar by negative 5% or so. All right, so what we could see over here is that at the start of Q2, the dollar weakness starts to actually resurface back into the FX market. Okay, so what's the reason of it? The dollar weakness starts to come back. So this particular chart here, right? Firstly, the candlestick chart is the dollar index. Okay, this chart is the dollar index monthly. So you realize that over here in the last 2 months, that means talking about April onwards, it starts to actually come down. And this is the current month of May. And it's now going to test the low that we see in the early part of this year. And very interestingly, where does it actually hit and actually shape this ongoing 2 months of decline? Okay, so we're talking about this is a dollar index. That means, let me explain again. What you're seeing here, dollar index, if the candlestick is going up, that means dollar strength in general. If the candlestick chart is coming down, that means dollar weakness in general. All right, so do I make myself clear? So far, so good? Yes? No? All right, so I'll assume that everyone is good. Okay, so basically what you see over here, I plotted this particular three lines here is actually the spread between government bonds. Okay, so what I mean over here is that I'm taking the spread of the 10-year US Treasury yield minus off the German bond equivalent of 10-year as well. And the orange one is the US 10-year Treasury minus the UK 10-year. And the one in turquoise, we call it turquoise blue or light blue is how I call it, is the US 10-year Treasury yield minus the Japanese JGB bond, means the Japanese government sovereign bond 10-year, same 10-year. So what I'm doing this over here is that, you know that, let's say we talk about two risk-free assets, okay? If the US Treasury yield 10-year is actually have a higher yield compared to the rest of the world, similar risk rating, that means similar credit rating, that means I compare against government bond to government bond. That means if the US yield has a premium over the rest of the world, money will tend to flow to the US, okay, because to take advantage of the yield premium. This is a very kind of a very simple kind of way of to look at things. So take a look at it over here. This is a monthly chart since the March 2008. That means why March 2008? That means that's also the start of the ongoing current long-term circular bullish trend of the global stock market. Okay, US dollar has been going up steadily. January 2017, then up to here March 2020, almost hit the high, similar high of Jan 2017 before it come back down. So you realize that this upward movement is actually moving in sync with this tree line. Okay, this tree, we call it the spread of this tree line. That means what? It means that if the yield on the US Treasury has a positive or has a premium over the German, over UK, over Japanese sovereign bonds, it will tend to actually benefit the dollar or move in line. All right. So if you realize that over here, right, even before this recent multi-month decline that has taken shape on March 2020 high until now, these three lines actually start to show lower high and lower low first. That means they decline first. All right. And also, do you realize that before the recent bounce at the start of this year, this is where the dollar come to bounce up, this tree line actually shape higher low, then thereafter higher high first. It's a kind of leading impact. Do you can you see that kind of leading element? That means what it means that, i.e., it moves hand in hand or direct correlation with the dollar movement index, but has a kind of leading kind of property. That means what it means that over here is that in order to see dollar strength coming back, US dollar government bond must have a premium against the German bond, the UK bond, and the Japanese bond. Okay, then you realize that in the last 1 month or so, all three of them starts to turn down. Okay, that is actually causing this current downside pressure right at this pullback support, broken turns into a resistance. All right, so that means right now we start to see the premium of the US Treasury yield is lesser against the German bond, the UK sovereign bond, and the Japanese JGB, which is the Japanese sovereign bond. That is actually causing this downside pressure. Okay, so what it means that right now, that means to see is there any further downside pressure on the dollar, I got to do a bit of technical analysis on this kind of spread, which I'm going to share with you all in my next few slides. All right, now let's look at other countries. Now we talk about German, UK, Japan. Let's take a look at Australia, Canada, and China. All right, so it's the same US dollar chart, except now the yield curve or the yield spread, the yield spread, I plot it by taking the US Treasury minus the Australia government bond, US Treasury minus the Canada sovereign bonds, similar 10-year, and US Treasury minus off the China sovereign bond at the same 10-year period, similar 10 period. So as you could see over here is that same impact. So you realize that the Australia one also started to decline versus the US Treasury. On the Canada one as well. In fact, the Canada one declined much earlier. Do you notice that over here, it started to shape a lower high much earlier than the Australia one. So that actually one of the reason to actually supports why this is about to actually depict why Canada dollar against just now the first chart I shared with you all, they appreciate the most against the dollar because it's being supported by a lesser premium on the US Treasury yield minus off the Canada 10-year sovereign bond, which is the government bond, because it starts to shape this decline of a lower high much earlier. All right. Then after you start to see the Chinese sovereign bond also turning down as well. The yield spread of the 10-year Treasury, US Treasury minus of the 10-year sovereign bond. Okay, so all in all, right, the first two slides I share with you all is the impact on the US Treasury premium. It has a direct correlation with the dollar index. That means, to summarize up again, if the year premium on the US Treasury is more versus the rest of the world, it will support further dollar strength. If the US Treasury yield premium starts to narrow or start to get lesser versus the rest of the world that we are seeing in the last 2 months at this moment in time, it will actually kind of add downside pressure on the US dollar. So far, so good. All right. So now, this is just a raw movement, the raw price section of the Treasury, we call it the US Treasury spread versus its respective government, rest of the world government bonds. So I need to do a bit of technical analysis on the spread of the government bond to see that whether will this ongoing current yield spread, means the premium of the US 10-year Treasury, whether this current narrowing is sustainable or will there be a reversal, a trend change, right? So I need to do a bit of technical analysis on that. So the next few chart is I will do the technical analysis of that particular 6 yield spread that I share with you all. Okay, so the first one, it will be the first two, pardon me, will be the US Treasury minus of the German Bund, which is the German 10-year sovereign bonds. All right, so I plot the weekly chart. Bottom of it, this is the RSI of the yield spread between the US Treasury and the German Bund. Okay, so you could see over here is that right now, in the last 2 months, the yield premium is getting narrower, which is actually supporting the current dollar weakness. Okay, so what happens that, do you notice that where why does it turn down? There's a high likelihood because it reached the RSI. This is the technical indicator to help us plot overbought oversold region. Okay, so we could see over here is that if you go back in the last historical price, the past few price action, you realize that once this RSI hit the overbought, it will actually add downside pressure on this yield spread. That means the US 10-year Treasury versus the German Bund over this point in time. Over this point in time as well. Over this point in time, this only a bit. Over here, a bit of pullback. And over this point in time here, doing this pullback, this slide over here. Then if you realize that at this point in time, it also hit a kind of extreme overbought level that coincide with the previous peak. All right. And it's just exited down from the overbought. Means for overbought, it actually extreme overbought, it exited down. And you realize that over here, there's still much more room to actually go to the oversold region on this RSI. So what does it tell us? It tells us that, hey, this yield premium, the US Treasury over the German Bund, has further potential to actually come down lower. That means talk about the yield premium on the US Treasury will tend to get lesser. That means it still has potential room to actually push down as depicted or as indicated by its RSI indicator, relative strength indicator, because it hit the extreme overbought and it exited from it. So i.e., it actually supports further dollar weakness. All right, so now let's look at the JGB, the Japanese bond. So you realize that this Japanese bond, the yield, the US Treasury yield over the JGB is also getting narrower in the last 2 months or so. Its yield spread here, the RSI has only just turned down. Okay, definitely the German one turned much more, right? So that's actually explained German is euro. So you realize that the euro dollar has really strengthened pretty significantly. Those were in the FX market the last 4 weeks or so. Last 4 weeks, it started to strengthen much more compared to the Japanese yen that is strengthened not so much, because that particular RSI, it hasn't actually dipped down further yet. It's still kind of hovering at the overbought level, but it hasn't kind of exit downwards. Okay, now so far so good. Everyone clear on this? Do anyone need me to actually kind of reiterate, or I try to actually take it from another angle? Okay, great. So I should proceed. Yeah. So do feel free to give me a shout out if you either you can't hear me or you want me to actually repeat certain portion of this technical analysis. All right, but I know that some technical analysis is a bit dry. I try to make it as exciting as possible, and I try to make it as layman as possible as well. Okay, so now the next thing I want to share, the next yield spread is between the UK, it means we call the gilt, and this is the Canada government bond. So you realize that this one over here on the weekly, this RSI, it actually hit the overbought much earlier, and right at the start of this year, it started to shape what I call a bearish divergence at the overbought level. When you have bearish divergence, that means the price action of the yield spread is showing higher high, but the RSI is showing lower high at the overbought and right at this resistance level. So what it means that, i.e., the momentum of this previous push up is losing strength, and there's a higher chance that it will start to shape further downside. That means what it means that the yield premium over the over the US 10-year Treasury might get lesser versus the UK gilt, which is the UK government bonds, similar 10-year. That is also kind of supporting potential further dollar weakness against the sterling pound. Now, this is the Canada government bond versus the US 10-year Treasury. So if you realize that it starts to come down already much earlier at the start, start late last year, it started to shape down lower high, lower low. Okay, and you realize that your RSI in fact has starts to hit the overbought and really starts to turn much lower at the start of this year. So that kind of explain why the Canada dollar has been so strong against the US dollar. All right, which I just shared with you all at the start of my presentation. And you realize that now it's in the kind of a middle of the RSI, but it hasn't hit to the oversold level yet, which is kind of a respective support that is in place since around late 2017. It hasn't reached this corresponding support level. That means, i.e., could be, or there may be potentially more further downside pressure on this US Treasury yield spread versus Canada. That means talking about further premium narrowing, or further we call it premium compressing of the US 10-year Treasury yield over the Canada government bond. Okay, that means, i.e., it's still kind of supporting further potential Canada dollar strength against the US dollar. Okay, so now I got okay. So the last two yield spread will be the Australia government bond and the China government bond. Okay, so if you look at the Australia government bond, it's really started to come down. Okay, recently it pushed up. This is the start of this year, but can't break above the previous high. Okay, and start to shape a bit of lower high as well. And if you look at the RSI, yes, RSI did actually hit the overbought level, but it's kind of also shaping the similar lower high that is being kept by this descending resistance as well on the RSI. So indicating to us that there is still kind of downside momentum on this yield spread between the US Treasury yield and the Australia government bond, kind of supporting further potential Aussie dollar strength as well against the US dollar. And the one that's kind of pretty much resilient at this moment in time will be the China government bond 10-year, the spread between the US Treasury and government bond. So if you look at the yield spread itself, it starts to improve late last year, and right now is not showing lower high yet. Similar high, it's kind of more like a sideways formation, But despite it now start to show subway formation, momentum itself, the RSI start to shape kind of lower high already. Okay, this high and this high said lower high. So this kind of bearish divergence and starts to take shape on the RSI, indicating to us that this current push up on the yield spread between the US Treasury and versus the China's government bond is getting lesser in terms of upside momentum, or we call it strength, where we could potentially see, or the risk of a reversal on the downside increases at this juncture due to the bearish divergence that's being seen on the RSI at it's kind of an extreme overbought level. Okay, so all in all, right, that particular 6 yield spread, US Treasury yield spread versus the rest of the world is actually indicating to us that the premium on the US government 10-year Treasury versus the rest of the world is getting narrower or getting lesser, that actually tend not to favor further dollar strength, but in fact kind of indicating to us there's a risk of further dollar weakness. Okay, so now let's look at the individual technical chart of the various pair that I'm going to highlight to you all. Okay, let's start with the euro dollar first, because euro dollar being the one that has the highest weightage in the dollar index, and also being the one that is most heavily traded globally. All right, so if you look at the long-term technical picture of the euro dollar is in fact very positive. Why? Because this is the think of it, this is the long-term descending channel previously, okay, where kept previous push up, and this push up is multi-month push up because this is a monthly chart. The last one was here February 2018, and it come down, and if you look at late last year, it started to actually shape a bullish breakout. And this bullish breakout, where it stopped, it actually stopped at the prior swing high of February 2018, 2340/2555. And last month is actually tested, well, in fact not last month, on the month of March, pardon me, March, it actually tested right at the pullback of this former descending channel resistance, now turns into a support. And the next month, which is the month of April, it actually shaped a bullish candlestick, okay, that almost take out March losses. Okay, because this is red now, so this is kind of a bit how I look at candlesticks. All right, so pardon me, someone said my slide is not maximized, so everyone can see my slide. Yes, no. Okay, good, good. Well, I'm not sure why some of the slide is not so I think you got to actually click on your the maximize button on your phone, or on the phone, or you just turn it to the other side, the horizontal slide. So if you're on your laptop, there's actually a box on the top right hand corner to actually maximize it. Okay, so what we could see over here is there's a strong price positive action last month, which is the month of April, right at this significant level, which is the pullback support of a former major long-term descending channel resistance. And very interestingly, your RSI, which is the monthly RSI, is shaping higher low, okay, which is telling us that long-term momentum is positive, and it has not reached to the extreme overbought level yet. That means indicating to us that, hey, this current push up that we see since the start of March last year hasn't hit, or hasn't get overstretched on the upside. That means, i.e., it could, or it may support further potential upside at this juncture. So those who knows about chart price pattern, you look at these 3 boxes over here, this is what I call a double bottom, a clear double bottom formation, which is a very major bullish reversal potential formation. Why? Because this is a monthly chart. It takes about 5 to 6 years to form, since 2015. And right now, what we see over here is that if we start to see a clear break above this 1.255 level, it could actually take us as high up as the next swing high, which is at 1.3840/3950. All right, so this is the kind of a very long-term technical positive configuration that we have at the moment for the euro dollar. So for this quarter, right, the strategy that I highlight earlier, still no change earlier on. So I'll be using this as my long-term key support level at 1615/1450. to actually look for a potential push up to actually test the neckline resistance of the double bottom first at 1.25555. Okay, this is the quarter. All right. So unless we have a weekly close above this 2555, 2555, then we could actually be more what you call it in terms of probability, the probability will tend to skew more towards the bullish bias, towards the next resistance at this level, which 3840/3950, followed by 4220 /4410 on the euro dollar. Now the next one will be on the Aussie dollar. Okay, so for Aussie dollar, right, if you look at it in the last 3 months or last 4 months, I would say, all right, since the start of this year, it actually hit a key resistance level. Okay, why is it key resistance level? It actually being kind of confluence or coincide by three different kind of elements or three different way of looking at it. The first way is the descending resistance from July 2011. Okay, that is capping the upside previously. The former pullback, the former ascending support from April 2011 taken down and now turned into a pullback resistance. And most recently, the January 2018 swing high that was actually tested twice and shaped this significant down move. 2 years plus of down move before it kind of shaped that V-shaped movement. And right now it stopped here. So 1875 is a very clear resistance to watch on the Aussie dollar for sure, based on the graphical elements that I share with you. But what's so interesting is that the RSI. So think about RSI, right? It's like a speed. Okay, so basically what is RSI? RSI measures a speed, the speed of any instrument that I plot that's liquidly tradable. So think about it. What does speed tell us? So in order for a car to actually travel far, you got to pick up speed, right? Similar for this RSI. That means in order for this thing to actually, or a particular Aussie dollar here to go up higher, it got to show momentum, positive momentum on the RSI. So how do I find positive momentum of the RSI? Think about RSI is like a speed, so or rate of change. Anything that is a rate of change tends to have this kind of leading element to it. Okay, so you realize that this RSI here, if I were to take this lower high, it actually corresponds to the resistance, the graphical resistance of this Aussie dollar. Notice is in parallel, it's almost the same, but you realize that your RSI actually shape a bullish breakout first, right above this parallel descending resistance, and also this descending resistance here that is similar to this Jan 2018 swing high. It shaped a bullish breakout first and then go sideways. But prior to this bullish breakout, what's interesting is that you notice that this lower low on the Aussie dollar is being reflected by a higher low on the RSI at the oversold region. So what it means that when the Aussie dollar is shaping this recent 2-year plus of decline, your RSI is not showing a lower low, but it's showing a higher low, indicating to us this decline here is in fact losing downside momentum. That means we're saying that from January 2018 all the way down to March 2020, this is the last potential leg of this long-term circular decline before the birth of a major uptrend. So this is what my RSI is telling me. Okay, so and what's interesting is that the current RSI now hasn't go up to the overbought region yet. That means indicating to us this ongoing longer term momentum that has started on March 2020 low has not reached an extreme overbought level. That means the probability of further potential push up seems to be higher at this juncture potentially, as shown on the technical indicator, which is the monthly RSI. Okay, so far so good. Now let's go to the weekly chart that will indicate to us the strategy for the Q2 quarter. Okay, so for the Q2 quarter over here, you realize that, yeah, this is the start of this happened actually towards the end of Q1 or the start of towards the end of Q1, where the price action start to shape that pullback. Also right at very close is 80 cents, which is right below 80.75, the upside trigger level. So what I have over here is that it actually come down in the last 3 or 4 weeks. The last few weeks or last 3 weeks or 4 weeks, it actually shaped a U-turn. You realize that? Can you see that, the U-turn? And this U-turn happened right at this ascending channel support. Okay, and I will actually use the 73.65 as my key long-term pivotal support for this quarter to maintain this bullish bias. And this level, if you plot the 200-day MA, is also the 200-day MA over it. And definitely this 80.75 will be my upside trigger level. That means if we have a weekly close above it, it may see further potential push up towards the next resistance at 89 figure level, which is the one-time Fibo expansion from the low of 19th of March. All right, and as well as the upper boundary of this ascending channel. That above it should take us up towards this congestion area here at 93.50. All right, your RSI looks pretty positive, still positive on the weekly RSI, bouncing, shaping higher low above the neutrality level, which is the 50 level. Okay, now sterling. Okay, so if you look at the sterling dollar, it also shaped a bullish breakout from this former long-term circular descent resistance from November 2007. Okay, so right now, right, it's actually trying to actually bounce off from this ascending channel support that is in place since March 2020 low, and also shaping this kind of double bottom. It's almost very similar to the euro dollar. So what I'm going to do over here is no change. I will use this area here, this previous resistance, tested one, tested another time, tested 3 times before it break out a broke that long-term descending resistance. So definitely this is a key support level to watch for this quarter. 1.3270 as my long-term pivotal support over here. A break above 43.80 should take us up higher towards 51.40, which is actually the pullback resistance of the former long-term circular range support from 2001 that was actually broken right at this onset of the Brexit that happened about 5 years ago, 4 years ago at 2016, all right, in the summer of 2016. RSI still pretty positive, shaping higher low above the 50 level as well. Very similar on the Aussie dollar. All right, now moving on to the Chinese yuan, the CNH, okay, the dollar CNH. So if you could see that the dollar CNH, very interestingly, on the February low, it actually tested this long-term support level, which is a long-term ascending channel support, right, that I draw from 2014 low. Okay, tested once, hit, come down, test again, bounce. All right, so for sure, right, this level here is a very clear downside trigger that this dollar CNH got to break. That means we're talking about this quoted dollar versus CNH. That means if this thing is going down, that means dollar weakness. All right, so right now what we see over here, this level got to break. That means a weekly close below 6.4 may take us down lower towards 6.16, 6.11, with the long-term pivotal resistance for this quarter at 6.85 to maintain this potential bearish bias on the dollar CNH. Okay, now the next one will be the Canada dollar. So this Canada dollar, so is something that I highlight earlier, which my Q2 2021 peak. That's my global market outlook, where I cover FX, I cover commodity, and I cover the broad-based stock indices as well as the team play to actually watch for the Q2 team play. So this one, if you want to recap, is actually in our YouTube channel. You can just look it from there. So at that point in time, I highlight why is it bearish, because why do I actually highlight Canada dollar as my pick to actually outperform the dollar, the US dollar, is because of the dollar Canada, because you know the key name, I don't plot Canada versus USD, because in terms of FX trading, the norm is US, 1 US equals to Canada. How many Canada? The only thing that I plot early on my first chart, because I'm going to show you all the performance against the rest of the major. Okay, so it's easier to plot as Canada as my base currencies. But when we're talking about trading, we use the norm, which is $1, $1 US equals to how many Canada dollar. All right. So if you could see from Jan 2016 to March 2020, it started to shape this very clear double top. And the RSI is actually shaping bearish divergence. And what you could see here is that it already broke that support level, that long-term support level that is being held from November 2017 in terms of price action. Okay, so this is the neckline of this double top. A weekly close below 2070 to take us down lower towards 120, potentially 1.06660, which actually confluence with the congestion zone over here, and as well as the long-term circular ascending trendline support that is still in place since November 2007 low. All right, so pretty negative or bearish elements that has taken shape on the dollar Canada. All right, so now if I go to the weekly, this was the recap previously at that point in time. Look at the long-term pivotal resistance was at 37 figure level. I put it. Okay, so if you look at where is it right now, it's actually coming very close towards the 2017 neckline. Okay, so what I do over here is that I will from 137 figure, I tighten down, lower down the long-term pivotal resistance to 1.3020. Okay, so what we see right now is that as it approached towards the 2017 neckline, the weekly RSI has really comes down to the kind of extreme or oversold region already. But at this point in time, it has no clear bullish divergence yet. So what it means if it has no clear bullish divergence, even though it's oversold, there can still be a chance that it can actually pierce through this level. All right, but nevertheless, when it comes to trading, we got to be a bit cautious if you are trading on the short term. Why? Because it's approaching a key support level at 2070. We may see a bit of medium term, that means, or medium term, I'm talking about maybe 1 to 3 weeks of consolidation first, right at this level, potentially before shaping much lower. Okay, so we just got to be a bit cautious when it comes to the shorter term trading approach from here. So that means we got to actually use the daily chart or the 4-hour chart to actually look at the gauge from here. But the long-term picture, we're talking about the multi-month approach, it's still pretty negative or pretty bearish, potentially on the dollar Canada. Then we're talking about dollar weakness against Canada dollar. So far, so good. All right, on the technical analysis chart. And also fundamentally it supports. Why? Because if you look at central bank policy, one of the central bank, which is in fact the first central bank, the first developed central bank, which is the Bank of Canada, they are more in favor of kind of withdrawing their ample monetary easing policy. That means in the last meeting, they actually mentioned that they're going to temper their bond purchases, all right, which make it less liquidity in the Canada economy. That means we talk about interest rate in Canada will tend to be higher versus interest rate in US. Because if you look at the US Fed Chair Powell is still insisting that the current global inflation pressure on the upside, because if you look at inflation situation now globally, from the prices of commodity spreading out towards business cost, we're talking about PMI data is showing that cost of the producer cost is start to increase significantly, and we talk about global commodity prices have started to jump up significantly as well year to date. But the Fed is still has a view that this movement in the commodity prices as well as business costs is will not have a significant impact on the consumer. That means you and I, the end user, downstream downstream inflation level. That means we're talking about inflation at this moment in time is remote as based on the points of view. So that's why we're talking about why that yield curve, the yield spread between US and the rest of the world, the premium is getting narrower because US still wants to adopt a very relaxed or very accommodating monetary policy versus Canada, which is the Bank of Canada, which is the central bank of Canada, has already indicated to the world that they are ready to actually temper their bond purchases. All right. So that's fundamentally explain why dollar CAD has a kind of weakness ahead. But in fact, the technical chart tells us much earlier. Okay, based on the formation of this double top, and you look at it on a monthly chart since the start of this year. All right. Now, dollar yen. So dollar yen last the quarterly outlook, I did highlight over here is that there's this pivot level at 109.85. RSI hitting the overbought level. So what is 109.85? It's actually the descending resistance in place since June 2015. All right. So in June 2015 over here, it has been capping further the further what I call it capping what I call further strength of the dollar yen from going higher, and it started kind of trade a very kind of multi-year sideway since 2018 until now. So 2 years of sideway range from here. All right. So recently it did a push up from 109.85, and now it come back down again. It reintegrate back to this level. So it seems to me that that earlier strength was a kind of a failure bullish breakout. It did have a clear break and it come back down again, back below 109.85. And if you look at the RSI, which I could draw a corresponding resistance as well, in parallel with the price action, it actually tested and retreated as well. All right. So definitely 109.85 is a kind of a long-term pivotal resistance that I will maintain for this quarter. So I'm kind of maximum is a sideways range. So at most, right, potentially it could actually retest 104.60. Then thereafter it will be a very a kind of a churning between 109.85 to 104.60. Unless 104.60 can be taken out, then it will take us potentially much lower towards 101.30/ 99 figure level. So this is a very key resistance. So this actually a key support, pardon me. Why? Because it was a support over here that it shaped this very strong push up to 2015, and prior to this it was a very steep move on the downside. So this was kind of a risk off event that actually triggered by the Brexit episode during the summer of 2016. Then from here it shaped a kind of a very strong V-shaped push up. So definitely this area here will be a significant support level to watch going forward. But the first one will definitely be 104.60. So unless if this 104.60 cannot be taken down on the downside, I'm still a bit what do you call it? More of a sideway bias between 109.85 and 104.60 level on the dollar yen. Okay, for the quarterly for Q2 outlook update. Okay, then now before I want to share with you all another pair to watch. Okay, so this particular pair I did not highlight during I would say, pardon me, I did not highlight in my Q2 outlook. Okay, so this is a new pair which I just realized, or I just spotted a couple of weeks, 1 week ago. Is before I spot that 1 week ago pair, let's take a look at the index, the dollar index I plotted in relation with the SPH SPH, what about SPH? SPY, the ETF of the S&P 500 versus Vanguard FTSE All World XUS. So think about it is that if this if this dark blue line keeps on going up higher and higher, it means that the S&P 500 US equity is actually outperforming against the rest of the world. So far, clear? Do anyone want to repeat this portion? Yes? No? Yes? Great. The kind of purple line is the US S&P versus the ETF of core Europe. That means Europe, the Eurozone stocks. Core means the big cap Eurozone stock, MSCI Eurozone stock. If this thing is going up, that means we're talking about S&P is actually outperforming the key European big cap stocks. Okay, so if you realize that over here, this is the US dollar. US dollar has been going up, all right, since 2019. It's really going up until December 2016 up to May last year. The strength it start to wobble, lower high, it start to come down. And if you realize that this wobbling of this US dollar from May 2020 last year, it led to a bit of hesitant of these two lines to actually slope upwards. You realize that? So what it means that at this moment in time, the performance of the US equity versus the rest of the world is not so rosy as in the past. All right, previously. Can you see that? It starts to be a bit sideways. Okay, doesn't mean that US equity coming down. It's the performance. Okay, let me repeat. This is the what we call performance. It's a ratio. That means US equity, what it means that doesn't mean that US equity is coming down. US equity may go up, but they go up as a lesser strength versus the rest of the world. Clear? That means we're talking about momentum. Momentum is lesser. That means we're talking about the strength, it means the upside momentum is lesser compared to the rest of the world, potentially. It's not mean coming down, it's think about it as a ratio. So they are going up as a lesser speed, potentially. Okay, so if you look at it over here, this two line, I plotted a moving average over it for this two line. If you look at the Europe one, that ratio of S&P 500 versus Europe, core Europe, it starts to actually cut that moving average. All right, retested it and actually pull back down. So what it means that over here at this current point in time, European stocks as a whole is actually outperforming the US stocks based on this ratio. And it actually happened with a weaker dollar, in line with weaker dollar. So imagine if dollar starts to break down, okay, this is a major support here, the dollar index at 88.16. What is 88.16? This is a monthly chart. The previous resistance, the previous swing high broken, turns into a pullback support at 2018, and right now is looking to test at this, coming towards this level again. So if it starts to break down below 88.16, potentially it may open up scope for a very significant potential down move on the dollar. So it's being reflected at this moment in time, the prices of dollar start to come down and test it 88.16. It's being reflected by the outperformance of the European equity versus the US equity. That if you look at the rest of the world, it hasn't come yet. Okay, it actually go back up to the moving average, and right now, but it fails to break above the previous peak. Notice that this was the previous peak recently at the start of this year, and in the last month, so this is the month of last month, it started to actually turn down as well. So there's some hesitant of it to actually outperform against the rest of the world. So rest of the world, that means all world, means it includes Europe, it includes Asia, it includes emerging market. All right, but very clear is that the European side of the story seems to be outperforming the US market. So i.e. what it means that over here is that in Europe itself, things are actually picking up pretty well. Okay, because previously Europe, if you look at the start of the year, they are saying that in terms of vaccination rollout, they tends to be getting lesser in terms of rate versus the US. But it seems to me that these things have started to clear up, and potentially there could be more reopening opportunity in Europe. And if you look at the amount of vaccine affected rates, also come down in Europe as well. So this is in fact beneficial potentially on the euro dollar. All right, so one particular pair I'll share with you is this is a risk off, risk off, risk on, risk off thing in Europe region itself. Is they look at this particular pair called the Euro Swiss. So Euro Swiss, right, is a kind of proxy, one of the proxy to actually take in kind of a risk on, risk off scenario in Europe. So if you look at the current state of Europe itself, it seems to be picking up, pretty improving, I would say, the COVID situation. And also as depicted by the earlier chart I shared with you of the European equities potential outperformance against the US. So that, right, could actually support this potential risk on pair Euro Swiss. Okay, so if you look at this Euro Swiss, right, this big fall was actually engineered by the depacking of Euro Swiss in 2015. Then thereafter, it slowly starts to churn up from 2018 high, then it came back down from here. May 2020 low was 1.0503, and if you look at it, it starts to shape a bullish potential double bottom bullish reversal configuration forming. The neckline will still be at 1.2 level figure. And what's so interesting over here is that previously the 50-week MA was resistance at this downtrend, that's 2 years plus of downtrend from April 2018, pardon me. It broke out of that 50-week MA, and this descending resistance, formerly descending trend line, formerly as a resistance from 2018 high. And before this breakout, the weekly RSI is showing a bullish divergence. And right now, the weekly RSI is holding above a corresponding support right below 50 at around the 45 % mark. And price action recently has started to shape a bit of pullback in the last since the start of this year, or the start of this quarter, pardon me, a bit of pullback. And right now it's actually coming towards this 50-week MA as a support, and the former swing high area that was taken out turns into a pullback support right now, confluencing at 1.0865. So if you look at the weekly candle, it start to shape a kind of a bullish doji as well at this point in time. So what I could see that as long as if this 1.065 holds, potentially we could see further potential upside on the Euro Swiss cross pair to actually test in first step this range resistance at 114.90. A break above it, a weekly close above it, should test the neckline resistance of 1.2 figure level. Okay, so all in all, right, this is the next pair that I like to share. It's a new pair, a cross pair that I would like to share to keep a close watch on, to actually take advantage of the improving situation in Europe. All right, so someone asked me a question. Okay, one second, let me expand it. Okay, one second. Okay, one question someone said, I miss the dollar yen pair. Are you bearish on this pair? Yes, the dollar I'm bearish, but the key thing is that I'm not so bearish versus the rest. Why? Because it's trapped within this range since 2018. So I'm still using that 109.85 as my key resistance to watch in this quarter. At most, potentially it could test down to the bottom of the support range at 104.60. Unless this 104.60 has been taken out, that I could actually validate further potential down move towards the next support at 130/99 figure. All right, so another next case. So basically one more question is deleveraging out of USD into commodity. Okay, in fact, what we are seeing right now is, in fact, the dollar, I will say that this ongoing we call it commodity prices that is very strong, is actually supporting dollar weakness, especially on the commodities related currency. So that's why I explained why the Canada dollar is the strongest, because via oil. Okay, the oil prices is pretty strong. So the next one that is related to the commodities currency play will be the Aussie dollar as well, due to copper, the base metal currency, and iron ore. So that should actually kind of support dollar weakness against this commodity story, which is actually supporting the dollar weakness story from this Q2, this ongoing this Q2 outlook as well. All right. So I come to the end of that presentation slide, which is the Euro Swiss one. Okay, so right now I'm opening to further Q&A question. Okay, let me touch on the FX first before I talk about Dow Jones. Okay, and anyone have any FX question other than the dollar yen, and as well as that commodity related question that someone posed to me earlier on? Is dollar sync a good indicator too? So okay, unfortunately, dollar sync, I do not have a close watch on it because it's not liquidly traded. Dollar sync moves very much in correlation with the dollar CNH. Okay, if you plot these two together, you see the direct correlation. So for dollar sync to actually move much down lower, potentially, or reinforce this down move on dollar sync, the dollar CNH needs to break, means they have a weekly close below that key support of 6.40 level. All right. Oh, Hong Kong dollar. We cannot use Hong Kong. Okay, is Hong Kong dollar similar to CNH? Okay, the answer is always that Hong Kong dollar is a fixed currency peg. All right, so you cannot look at CNH indirect. What CNH is more or less floating. But for Hong Kong dollar is pegged by this. There's two fixed upper band and lower band is pegged at that rate. So for Hong Kong dollar, right, there will be no clear uptrend or downtrend on the longer term. It's just basically two horizontal line. All right, so I can't actually do technical analysis unless you want to do it on very short-term technical analysis. We talk about the hourly chart or or on the hourly chart or the 15-minute chart. So if you open up the weekly chart on the dollar Hong Kong or the monthly chart of dollar Hong Kong, you just see two horizontal lines on the upper limit and the lower limit, which is being defended by the Hong Kong Central Bank. All right, Ken. Okay, anybody wants to the FX question? Any other FX question before someone asking about Dow Jones? Yeah. All right, so let me touch quickly on Dow Jones because someone posed me a question about Dow Jones. But I understand that your concern about Dow Jones because of yesterday's there's this we call it that particular pullback or that particular carnage that is being what I call inflicted by the tech stocks spreading over to cyclicals and the rest of the spectrum of the US stock market that causes Dow Jones to actually underperform. Okay, so if I were to look at Dow Jones, all right, so let's go to Dow Jones. Okay, let me open up my chart. Okay, someone asked me about the Aussie dollar. Okay, give me a minute. Let me cover very quickly on the Dow Jones first. Okay, because all right. Okay, Dow Jones. Okay, so this is the chart of Dow Jones. Okay, so that I shared in my quarterly outlook. So Dow Jones over here, yeah, we have a strong. This is the long-term support here at 29,400 level. So what we could see right now is, okay, let me remove this. Okay, this week of, okay, so far this is the weekly candle. So this weekly candle now is actually now testing that previous resistance that was taken out, 33,680, very close. So what we could see is that, okay, this is the weekly chart. Let's go down to the daily chart. Okay, so if you look at the daily chart over here, it's in fact pulling back to a key medium-term support level. That resistance at 66, what's the level? This level, 33, 680, 33 200 level, which is the ascending channel support. All right, and right now the price is forming a hammer, a daily hammer. So what we could see over here is that it seems to me that this level here is pretty crucial for a potential reversal back to resume this ongoing medium-term trend on the Dow Jones. So all in all, right, I still do not see a kind of start of a major risk-off scenario yet on the cyclical and value play, and which translate the rest of the world. So I tend to see more of a profit taking instead, because Dow Jones, or i.e. the cyclical and value spectrum of the US stock market, has been the winner or the winning sector for the last we're talking about last 4 to 6 weeks, or talk about 4 to 6 weeks. So it's a bit of profit taking from here. All right. Now, someone asked me about this thing about Aussie dollar again. Let me ask about Aussie dollar. Uh, Aussie dollar seems to be strengthening slower than copper prices. Does it mean that it will have a lot of strength left? Okay, so back to my chart itself on the Aussie dollar. Okay, everybody can see my screen, right, on the Aussie dollar. Okay, so all in all, right, yes, Aussie dollar has been strengthening lesser than copper. Okay, because copper, there's a lot of reason. Because copper, there's some supply chain issue as well. Supply chain, there's some not supply chain, supply issue, because certain copper mines are kind of a do not actually produce in full capacity. So that's the supply chain issue that actually supporting copper. So that's why copper is tends to strengthen much more faster than Aussie. But all in all, it actually have a feedback loop being spilled into the Aussie dollar. So for me, that Aussie dollar, right, in order to see that significant strength coming into the picture, the 80.75 got to break. That means it got to have the weekly close above it before we start to see significant momentum feeding back into the Aussie dollar. All right, but the technical chart is still bullish at this moment in time. All right, good. Now, one more question. Also, rising interest rate, will it have a downward effect on equity market? Okay, so we take it one step at a time. All right. So rising interest rate, in fact, is good. Why? Because it tells us that the economy is growing, i.e., correct. So now comes to the picture over here is that markets will be always ahead of real economy. Okay. So it will comes to a point in time that rising rates will actually lead to a potential sell-off in equity market. And this time around, we may see a much more pronounced sell-off versus the previous, we call it the previous significant correction. We're talking about significant now, we're talking about a fall that's more than 30% or 40% that actually took shape in the subprime crisis, which is 2007, 2008. From there onwards until now, we don't see any significant circular correction yet. So why do I say that the fall itself might be more drastic than the last one, the last significant correction that we see in 2017, 2018, is because the amount of leverage that we have in the system right now, which is much more. All right. So now, so the key thing over here is this rising interest rate, right, will only comes to the point that unless it will have a impact on equity market is when the prices, the earnings growth starts to be lesser than the rate of commodity prices increase. That means, i.e., we're talking about why I use commodity prices. Commodity prices will be always a leading indicator to tell us how fast inflation has come into the picture. So far, the Q1 US earnings has been rising on a very higher rate because last, if you take out year on year, it's a low base impact or effect from last year. So if we start to see the commodity prices increase, it's actually more than the increase in earnings, rate of earnings. We talk about earnings increase. This is where the problem might come. All right, so there's a risk of inflation coming. Then those who understand the way how sector rotation move. All right, so in this ongoing bull run, the previous move was being supported by outperformance of technology and growth stocks. So for those who follow my Q1 outlook, I did highlight to us that from this year onwards, because of the potential rising commodity prices, technology and growth will actually underperform. Then what's actually outperforming, that's what we're seeing right now, is your cyclical and value. That means we're talking about your energy, your materials, your industrial, followed by your financials. That is the market leader right now. All right. So now the market will rotate to this move. Okay. So as y'all could see over here is that this particular move towards the cyclical is getting more and more well known as reported in the media. Okay. So the next one that I'm looking at were to actually complete the whole potential sector rotation before that longer term cyclical bear market comes into the picture will be a move towards defensive. And i.e., once it moves towards defensive outperformance, okay, what is defensive? Defensive, we're talking about consumer staples, utility, and healthcare is one of them as well. Why I consider that defensive? If inflation starts to pick up higher and higher, inflation risk starts to increase into the system, markets participants will actually be more favorable to actually pay better premium towards stocks or towards company that has more certain stream of revenue flow, i.e., which is in the defensive sector, like utilities and consumer staples, because their revenue stream is much more stable. But once inflation starts to pick up, revenue streams of corporation in general will tend to be very volatile. Okay, because of the higher costs, all this coming into the picture. All right. So this is something that I will actually take a look at based on this kind of strategy. We call it movement in the market. Okay, so I hope that I could answer your question regarding about that rising interest rate and on the impact on the future impact on movement on the equity market as per se in general. Okay, so we have, okay, just now as we approach around 8:05 now. So I have one more last question before we call it a day or call it a great evening. Anyone have any more questions? All right. So if no question, thank you for your time. I will actually post. Okay. any comment on Nasdaq further downside? Okay, one more last question on Nasdaq. Nasdaq itself more sideways. Why? Okay, very quickly. Okay, let me go on to the chart. Okay, actually this was supposed to be the FX market outlook, so it seems to me everybody's more concerned about the equity market. Okay, let's go to the Nasdaq chart. Okay, so in fact, those who actually followed my Q2 outlook, I did mention Nasdaq. There's one key levels to watch on the Nasdaq. Okay, let's start off with the quarterly outlook first. Okay, so we do a top-down approach. Okay, still remember that quarterly we are neutral between 14,040 and 12,000 figure level. Okay, why? 1414 is the key resistance that I highlight earlier on in my Q2 outlook that I shared with you all in earlier March. That level indeed can't break, and now it starts to pull back. So from a longer term approach, right, the maximum downside it could be at 12,000. So it's actually between these two range for a quarterly outlook perspective. So if you want me to drill down to a much more weekly approach, then we're talking about multi-week potential outlook. Let's start with the daily chart first. Okay, so you look at the Nasdaq daily chart, it's kind of flirt around with the former swing high area of 17th of March, broken out, hit exactly at 1440, refused to break and come down back again. All right, so that means from this region itself, what I could see is that I will use this as my support level, 13,255. Potentially it could shape a push up, but it cannot go above 1440 yet unless it has a weekly close above 1440, which is my higher longer term level that I share with you on my quarterly outlook on the weekly chart. Okay, so now if you go to the 4-hour, you could see where it bounced. The way it bounced over here, it actually bounced right at the neckline support of the inverse head and shoulder that was taken out recently and hit the 1440 level, which is the upper limit of my range that I defined in my Q2 outlook before it pulled back down again. And how it pulled back, lower low, higher high on the RSI. Okay, bear in mind, this is not a weekly RSI. This is a 4-hour RSI. So 4-hour RSI, it has shorter time impact than a weekly RSI or monthly RSI. So at most, right, it could actually potentially shape a push up, maybe back towards this region here again, 13,600, 13,700, maximum 1440. So unless it could have a weekly close above 1440, then that I could be more in terms of probability to potentially validate a further up move on the Nasdaq. So this is how I see it from a technical picture, but very interesting technical movement as it starts to, you see how it react according to the key technical levels. All right, so with that, I do not want to take much more of your time. I hope that I could share a pretty much interesting session for you all this evening. And I wish you all a great evening ahead. And tomorrow is a public holiday in Singapore. So I wish all of our Muslim friends happy Ramadan, Hari Raya. And I see you all again in my next webinar. Thank you so much.